I'd like to thank you for joining us today at AAFCPA's Year-End Business Tax Planning webinar. During today's session, we will be discussing federal, state, and international tax planning strategies that affect privately held businesses. We will be presenting ideas for you to consider as part of your year-end tax and business planning. My name is Rich Weiner, and I'll be moderating today's session. I am a tax partner in our transaction advisory and commercial tax practices. Before I introduce our speakers, I'd like to quickly cover a few housekeeping notes. First, this is an interactive webinar. We encourage questions at any time through the question function you'll see on your screen. We will save all questions until the end of the session as time allows. For those of you who are CPAs, today's session qualifies for 1 CPE credit. To be eligible, you will need to answer the 4 live polling questions that pop up during the presentation, as well as complete the evaluation form that pops up at the completion. We will be emailing CPE certificates within 3 weeks. In addition, today's slides will be made available in the chat for you to download. Lastly, this webinar is being recorded and available to watch again or share. So without further delay, I'd like to invite our speakers to introduce themselves.
Hi, I'm Mike Ratty. I am a manager in our commercial tax group, and I specialize in credits and incentives.
Hi, I'm Kelly Zach. I'm the Director of State and Local Tax, and I work with lots of different types of clients in multiple states to find opportunities to save tax and to mitigate risk.
Hi, everyone. My name is Bella Amigood, and I am a partner focusing on international taxation for your inbound and outbound transactions.
Hi, everyone. I'm Destiny Flood. I am a partner in our outsourced accounting and fractional CFO division, and we support companies with supporting finance and accounting needs.
Great, thank you, everybody. And with that, I'm going to turn things over to Michael Ratty to get us started.
Thanks, Rich. We're going to start today's webinar talking about some significant changes that pertain to strategy and planning for federal purposes. The first thing we'll talk about today is the Employee Retention Tax Credit. This is actually a COVID benefit, and it is a fully refundable tax credit based on qualified wages and health plan expenses. It's a little bit of old news, given that this was a number of years ago at this point, but the credit can still be claimed through amended payroll filings, most likely the Form 941X, as you can see here. And the deadline for 2021 claims is April 15th, 2025. Due to a significant number of scammers, marketers, promoters, and such, generally what we refer to as credit mills, the IRS did place a moratorium on new credits, which was recently lifted in August of this year. Because of all these issues with claiming the credits, the IRS developed a number of procedures for withdrawing the credit. We talked a little bit about this during last year's webinar, so I won't get too much into this, but if you believe that you may have used one of these types of companies, just contact your AAFCPAs partner as soon as you can to get this squared away. One thing that we did want to discuss for this year, though, that was not a part of last year's webinar, was the 2021 Voluntary Disclosure Program. This is Form 15434, which is used to participate. Now, there are a number of qualifications that you need to meet in order to participate in this program. One of them is that it's specifically for 2021 claims. You now think you're not entitled, you're not under audit or criminal investigation, and the IRS hasn't reversed your claim. This is really meant to be getting out in front of the issue rather than them coming to you with the issue. And now some of the benefits here. First of all, only 85% of the credit cashed actually has to be paid back. Essentially, you are getting 15% of a benefit that you actually were not entitled to. So that's pretty interesting. There's no interest that needs to be paid back. You don't need to amend your tax returns as you would under normal circumstances. There's no penalties on this if you pay back the tax by the time, or the credit by the time of the closing agreement, and they won't audit your claim. I will note that the program ends November 22nd, which is now less than a month away. So If this is something you think you should be looking into, I would contact your partner as soon as possible, because this will take some time to sift through. Next topic we want to discuss is research and development costs that now need to be capitalized over 5 years for domestic costs and 15 years if the costs are internationally based. This had a pretty significant impact on 2022 taxes, lesser on 2023, and will be less in 2024 as more costs are amortized. The House passed a bill to reverse this year, but the Senate voted it down. There's been a number of attempts to try and reverse this. It's hard to say whether a lame duck Congress would act on this, but the timing of any kind of repeal is important because tax provisions for financial purposes are based on enacted law at year end. So if the law is repealed or reversed in any way after December 31st, that's going to create a significant difference between what we file on your tax returns versus what actually appears on your financial statements. A new credit that we saw this year was the retirement startup plan tax credit. This is a pretty wordy slide, so I'm not going to get too much into it. I just want to give you the basics on it. It's for smaller employers, generally for 100 or fewer employees, and it's a three-pronged credit, essentially. First is a credit for startup costs. That's up to $5,000. There's a credit for employer contributions up to $1,000 per employee. And there's also an automatic enrollment feature that gives you a $500 credit for 3 years. So if you have any thoughts that this you might qualify for this, we'd urge you to reach out for this as well. Next, as you may know, a number of the provisions in the Tax Cuts and Jobs Act were temporary and are due for expiration at the end of 2025. First one we want to talk about is the state and local tax cap. This is the $10,000 cap on state and local taxes on Schedule A on the individual tax return. This also affects pass-through entities because a number of states enacted workarounds essentially to pay the tax at the corporate level rather than the individual level, essentially bypassing this. It's going to take some analysis to determine whether these workarounds are still advantageous or not. The next is the qualified business income pass-through deduction. Currently, most pass-through entities are eligible for a 20% deduction on business income at the individual level. This is essentially to bring this into parity with the 21% corporate tax rate, which will be remaining, by the way. Next expiring is the employer credit for paid family medical leave. To the extent that employer covers family medical leave expenses, they may be entitled to a 12.5% credit. And finally, we've got some generally green credits with the Inflation Reduction Act. The Inflation IRA really expanded or extended a lot of credits for individuals and businesses. You can see a few of them here. Most of them are for either manufacturing or building homes. We see the qualifying advanced energy credit, which is for manufacturing facilities with green tech, the advanced manufacturing production credit, which can be worth up to 10% of the cost of critical components sold, the new energy efficient home credit, which is for construction of new homes, including apartments and retirement homes that's certified by third parties. The commercial building deduction was expanded, which is for new construction and retrofits, and it's based on cutting costs by 25%, energy costs that is. And also there is an increase in the amount of research and development credits that could be used against payroll taxes. Generally for startup businesses or that have no income tax liability, you have the ability to use research and development credits against your payroll taxes. This was previously $250,000. This has since been increased to $500,000. In most cases, the credits can be sold, so there's pretty good benefit even if there's not refundable, or even if the credit's non-refundable, or if there's not a direct pay provision attached to it. Generally, these credits sell for, I believe, about 85 cents on the dollar. And just a quick PSA, we are going to be having a post-election fireside chat on November 13th from noon to 1, where we'll discuss potential new and expiring tax provisions based on the results of the election. And finally, some key takeaways here. You should consider whether it's appropriate to review your ERTC claims. Generally, as I said, this is for those of you that may have used these credit mills. Just want to make sure everything's squared away with those. We should analyze the effect of R&D capitalization on taxable income when tax planning. This is really it's waning in effect, but it's still only year 3 as of 2024. So generally speaking, capitalization is going to be bigger than your amortization at this point still. You should consult with your AAF partners if you think one or more expiring tax provisions is going to affect your business. And you should evaluate whether adopting green energy can be beneficial for your company. And with that, we'll go to polling question number 2. How confident are you that tax provisions expiring at the end of 2025 will not affect your business? And with that, I will send it over to Kelly.
Yeah. I'm good, Rich, just to cover a couple of items, adding some additional commentary. With regard to the ERTC, the IRS announced 2 weeks ago that they're going to be processing what should be the final 400,000 claim requests that would represent $10 billion of refunds to people whose applications have not yet been reviewed. A couple of thoughts on with regard to the R&D and the interaction of the capitalization with the credit. If you're able to exempt your research and development costs, if they're not truly R&D for purposes of capitalization, they won't qualify for the credit either. So for a profitable company, you won't be able to have your cake and eat it too, unfortunately. With regard to the credit itself, the IRS has slowly but surely been increasing the amount of disclosure required in order to claim the credit. And this is something that our clients who claim the credit will be working with you more and more on this over the weeks and months as we get into the 2024 filing season. Lastly, as a segue into Kelly's discussion of state and local tax, many states, California being the most notable, has decoupled from the federal rule requiring the capitalization of R&D cost. Now, for a startup company, whether it be in the software or the pharma space, you may not have need for the current deduction, but in California, at least, you can still avail yourselves of the old rules that allowed for elective capitalization. And on a case-by-case basis, that's something you may wish to consider. So the poll has appeared. If you haven't already answered, please do so. And in the interim, I'll turn things over to Kelly.
Great. Thanks, Rich. Happy to be here. Good afternoon, everybody. First thing I want to talk about is some of the significant developments we saw during 2024 in various areas of state taxes. The first thing at the corporate income tax level, Public Law 86272 is rearing its head again. That's a federal law that basically limits the state's abilities to subject taxpayers to tax. And it says only if they're doing business in your state are you allowed to subject them to tax. Well, the definition of doing business has morphed over the years with the e-commerce platforms and digital products. So the states are trying to take a more aggressive approach as to what constitutes doing business. So we're keeping an eye on that for all our clients to see if any other state tax requirements pop up. Again, at the state, across a lot of states, they're looking at their NOLs, their net operating losses, saying, a lot of them are limiting the amount of taxable income you can use a net operating loss against. So those are limits on a year-by-year basis. Some states are limiting the carry forward or carry back periods. So something to keep our eyes on. One really significant case that happened during this year in California, it was actually Microsoft, relates to dividends paid to foreign entities. Those kinds of dividends are allowed to be deducted from taxable income of corporate tax returns. But what Microsoft also did was included those dividends in their sales factor calculation. So that, in effect, creates a much smaller sales apportionment percentage for the California return. the franchise tax board said, no, we don't agree with that. If you can't get the deduction and also dilute your factor. But the Office of Tax Appeals actually sided with the taxpayer, which was a huge win for them. And so it's just really something for us to keep an eye on. One of the very few cases where a state may allow some double dipping on these kinds of benefits. Massachusetts very significantly is going towards single sales factor starting in tax years starting in 2025. So it's really impactful for both Massachusetts taxpayers and out-of-state taxpayers. So for Mass taxpayers, there's obviously a much more increased focus on the sales factor, and there's a potentially bigger impact when sales are being thrown back to your state or potentially thrown out. So that could significantly increase your Massachusetts percentage. And then for out-of-state taxpayers who often have the ability to dilute the factor because they have no payroll or property in the state, that benefit goes away as well. So they can likely see their percentages increase. So it could be very significant. And then South Carolina, which is typically a separate reporting state, they had a specific instance where they could require mandatory combined reporting if they are seeing intercompany transactions among affiliated groups, if they lack economic substance or if it's not done at arm's length. So don't always assume that you can file separately at every state level. We always look at what the rules are potentially for mandatory combined. Sales tax, obviously the hot items are still digital products and services, mainly how are states defining them, how your product fits into their definitions. The Multi-State Tax Commission is actually working on a uniform definition, which is going to be super helpful for the states. Doesn't have the weight of law, but it does help states define how they're going to define digital products. And that in turn will help taxpayers figure out where their products lie. So we're definitely focusing on that. And the states generally don't do a lot of increasing of their sales tax rates. What they're starting to do more of is expanding their tax base, whereas they would say services that generally had been exempt from sales tax, they're now adding those to the list of taxable services. So you have to look from year to year what your product is and how the states are determining whether it's taxable. Exempt certificates are just something you are normally collecting. The states are taking a harder view in that you're supposed to accept them in good faith, meaning you need to really be sure that the certificate you're getting makes sense, that you really agree that your customer is exempt, you are sure that they are reselling your product. You can't just take it at face value. So keep an eye on that. And then retail delivery fees, which started in Colorado and Minnesota, a couple more states are picking that up as well. It's just an additional, they don't call it a tax, but it feels like a tax. It's based on, a certain flat fee on the number of products you're transporting within the state. And software as a service now taxable in Vermont. So keep an eye on your customer list on your sales by state. And if you're selling to Vermont customers, then you'll need to subject that to sales tax. An individual, I would know we have a whole webinar on the individual tax planning, and Mike mentioned the SALT cap. So I just wanted to reiterate that it is set to expire at the end of 25. And not only is it going to affect the federal returns of pass-through entities, but the states that have adopted the pass-through entity tax, some of those states have definitively said when the cap expires, PTE goes away. Others, we may need to look at, we may have to do another cost benefit analysis to see which is more beneficial. So that could have a significant impact at the state level. I wanted to spend some time on sales and use tax audits because they seem to be much more prevalent these days. And you wonder, how or when will your company be selected? And it could be various ways. You could get a nexus questionnaire. And if you send that back without clearly really looking at what they're asking, that could create an issue at the state level. Always reach out to the SALT team if you get one of those questionnaires, because we've seen a lot of them and we know which ones are fishing expeditions. Also, if you're customers, if you have large customers being audited, oftentimes the states will look at their invoicing and see potentially your name as a vendor, and it might highlight something they want to go after you next. So it could be various ways. One of the biggest things we're seeing is remote employees. Once you have remote employees in a state, You then are subject to withholding. You're then filing payroll tax returns. And guess what? All these different tax agencies are speaking to each other. So there's a chance that the sales and use tax guys are going to hear from the payroll tax guys that they might have a hot item. So really be aware of that. Sales and use tax audits, more than any other, in my opinion, are all documentation. You have to make sure you have your exempt certificates and your resale certificates. You have to be able to show the auditor that you can run reports for all your sales, that you can get copies of invoices when they're needed. And that all of that goes a long way to establishing a good faith relationship with the auditor, that you have a full handle on your systems, that you're doing everything correctly. So really get that documentation set up before an auditor walks in the door. Low-hanging fruit usually in an audit is use tax, meaning if you buy something and your vendor doesn't charge you sales tax, if what you're buying is taxable, you're required to self-assess use tax and report that. So the auditors will look at expense lists, they'll look at fixed asset purchases. So really keep an eye on that as an exposure area. Statutes of limitations, we want to keep an eye on that. They may ask you to extend. And one thing I've noticed a lot more of is auditors using sampling agreements. So before you agree to anything with an auditor as to what period they're going to sample, please reach out to your advisors and make sure that that makes sense, that you have the proper records that would make that feasible. Construction is got its own tricky concept. So in a nutshell, in general, contractors are considered the end user of the materials that they buy to use in their construction projects. So again, generally speaking, the contractor will pay sales tax when they buy the materials, because on the other end, construction services, with very few exceptions, are exempt at the state level. So just making sure you know where the tax is being charged, how it's being charged is very important. If you're not paying sales tax, there may be use tax implications if you transfer your materials to a different state. There's a distinction between tangible property and real property. And believe it or not, the way your contracts are set up can have a sales tax implication. If lump sum, it can be treated one way versus time and materials, where you might be able to pass on that sales tax responsibility to the customer. And if you're doing construction for exempt organizations, you may be able to avoid sales tax altogether. I'm not going to go into all these in detail, just really want to reiterate local taxes are becoming much more prevalent. There could be gross receipts, service fees, payroll tax receipts, and a myriad of different fees and taxes that localities are doing in addition to state taxes. Chicago's the one that's the most impactful that I've seen for my clients, because their tax applies to software as a service. So it's a 9% rate, so it's significant. And they're getting very aggressive on that. So if you have big Chicago customers and you sell SaaS, please reach out. We can do some voluntary disclosures, but we can certainly make sure you're getting into compliance. We put out a blog a while back about the Mass Tax Amnesty Program, so hopefully you've all heard about that. It runs from November 1st through the end of the year. Basically, for unfiled returns, if you have unpaid assessments, any audits out there, the requirement is that you have to pay the tax and interest, but you can apply for amnesty against any penalties. You can't use it if you've already paid the tax. You may be approached by the Department of Revenue proactively that you are eligible for this, so keep your eyes on that, but reach out to your advisors if you think you might have any areas that would apply. And all of these things come to a head with due diligence, because there's such a lack of uniformity among the states and increasing complexity. We have seen in our transaction advisory team a much higher emphasis on state tax compliance than we've ever seen before. So the buyers are generally digging very deeply into income tax, sales tax, property tax, unclaimed property, because those are such high areas of exposure. So it makes a difference if you're doing an asset sale versus a stock sale. But keep in mind, even if you're doing an asset sale, there still may be successor liability issues, which in essence means the buyer becomes responsible for the seller's liabilities. So that's why they're going to dig deep. They want to make sure there's nothing hidden out there that they'll be responsible for. So if you're the seller, or if you think it might come down the road, we want people to be proactive and to think now where your salt exposure may be and try to mitigate that. Do voluntary disclosures, take advantage of amnesty programs, get registered in states that you need to be registered in. And then your due diligence process is going to be much cleaner and much more streamlined. And if you're the buyer, same thing. Look very deeply at all of your sellers, all of your targets' salt issues, because you don't want to get surprised down the road. You don't want their headaches to become your headaches. So really important to dig deep on those. And this is just a lot of the things that we can do for you in the SALT team. We always look for tax planning and tax saving opportunities, but we also want to be mindful of the risk you're bearing. We want to be proactive and help you mitigate any risk. So reach out at any time that you think you might have a problem. And with that, we'll launch a poll. And I'm going to turn it back over to Rich while we wait for the poll to come through.
Great, thanks, Kelly. Few additional comments. With regard to the mass single sales factor coming into existence in 2025, it will also apply to limited liability companies and partnerships. For those who have been operating under current law, especially as a manufacturer, as a corporation, the company could apply the single sales factor, but not as a partnership or LLC. So that's going to be a welcome change for next year. With regard to various income tax matters, the choice of entity when you're starting a company, C Corp, S Corp, LLC, each of those has ramifications on how state taxes will be reported in every state. So if you are creating a company, or if you're looking to restructure your current setup, we recommend that you talk to us beforehand. On the sales tax side, with regard to sampling agreements, one story out of my own personal background is that we had a client that was going through a sales tax audit that, for whatever reason, had 4 or 5 different controllers and CFOs during the audit period. And we had to be very careful in choosing which period was going to be sampled, just because each of those CFOs and controllers had various strengths and weaknesses. And so when you're using a sampling period and agreeing upon one, the wrong period could cost you a lot of extra money that might otherwise be the case over a 3-year period. With regard to remote employees, there was an article in the local press recently about people becoming digital nomads, either traveling the world with their PC or perhaps renting an RV and setting up camp in various states. For that reason, a lot of HR departments are making it mandatory for employees to check with them before deciding to relocate if they do have a remote work policy, just to make sure that nobody's opening up Pandora's box. And if there's an overall theme when it comes to multi-state tax, what you're seeing is that the states are finding more and more ways to reach into the pockets and of companies and individuals located out of state. Politically speaking, it's a lot more expedient than funding a state's operations and raising taxes on their own voters. So if anything, you're going to be seeing more and more of this over the coming months and years. Thanks again, Kelly, for that presentation. And we're going to go from state tax to international tax. And I'll turn things over to Bella.
Thanks, Rich, and good afternoon, everyone. And today I want to focus on international tax planning and strategy and the importance of it. In years past, we've done this section of the webinar really heavily focused on compliance and its pitfalls. But I want to kind of go back to the drawing board and re-examine the structure. Why is it set up the way it is? See how we can evaluate if you're an existing company or if you're just starting up, to really paint the picture, keeping your business's goals and objectives in mind. And so today I'm going to be talking about the importance of this tax planning with cross-border transactions in different scenarios, with the goal in mind that really we want to minimize your global tax liability, and we don't want to pay double tax if we don't have to. And so navigating both the US and the foreign tax systems is going to be very important. So for companies, choosing the right tax treatment for your international footprint is going to be key. In years past, we've seen a lot of US companies who decided to venture out outside of US set up a foreign subsidiary. And with that in mind, that foreign subsidiary would be subject to controlled foreign corporation rules, which could potentially defer some US taxes, but the compliance and transfer pricing obligations with that would be pretty complex because you would have to pay attention to transfer pricing in both countries. So what we've seen lately with the fact that US has a lower corporate tax rate of 21%, so we've seen lately recommending a lot of times setting up a foreign branch abroad instead of a foreign subsidiary. Because what that will allow is for pass-through taxation, so that foreign operation would be taxed as part of your U.S. income tax return. It would allow for simplified reporting, and therefore it would allow for simplified transfer pricing obligations with only one country to worry about, the U.S. We've also seen some hybrid structures where we can sometimes file what we call check the box form and have an entity be treated differently depending on the jurisdiction. Couple of key US tax concepts that I want to make sure we keep in mind as we go through these foreign concepts is the US used to be on a worldwide taxation system, but with the enactment of the TCJA Act in 2017, it started immediately taxing your foreign subsidiaries' earnings in the year that they earned overseas. And so with that coming into effect, really US is now on a hybrid approach or a quasi-territorial tax system. For companies that don't have a significant international footprint and really are just operating in US and perhaps just selling goods or services to a foreign country customer, what becomes really important here is keeping in mind double taxation risk. So the foreign country could tax you, US could tax you, and so we would want to help you mitigate that. And there's a couple of ways to do that. One, of course, I'm sure you've heard of a foreign tax credit. It's basically a system and a form set up to avoid this double taxation. But there are cases where sometimes it might not be beneficial because US companies heavily into net operating losses. Another methodology is applying and obtaining a US certificate of residency, and that's to claim the benefits of a tax treaty. So here I want to introduce the concept of tax treaties, the importance of understanding what benefits you may have under that, understanding that each country's treaty could be different. So we would help you get through reading this, understanding where you want to do business if you have any choice. And so this certificate of residency would allow this foreign customer perhaps to not withhold tax on your selling price. The default is usually 30%. So this tax treaty benefit and the certificate could potentially lower it down to 0. So we are working currently with a couple of clients in this process. And so shopping for the right tax treaty for the right country is definitely going to be paramount. Another important topic that has come alive in the recent year or so, more so than before, is transfer pricing. And really, it's a simple concept. It's just making sure that you are having arm's length transactions with your related parties. And with IRS increasing their forces, hiring in their international unit, we feel that we're going to be soon seeing more transfer pricing audits and questioning from them. So what we see in this case is we have a lot of companies that have been set up a while ago, and they had done their transfer pricing study, and it's sitting in the shelf somewhere in the filing cabinet, and the business has changed since that transfer pricing study has been created. It could be due to COVID, it could be due to operational changes or market changes, what have you. But it's important to reevaluate the transfer pricing strategy you have to make sure it's aligned with your goals, with your business operations. And so if in case you have a complicated global structure where one entity is heavily in having net operating losses, and another country is your manufacturing branch, and another one could be your R&D activity, we want to take a look at that to see if we need to make any transfer pricing adjustments before year end, before 12/31/2024, to make sure that perhaps those NOLs could be utilized. And then if that's the case, then you have a clear savings in tax plus a reduction in transfer pricing audit risk. So it's a win-win in both cases. Some other important concepts that I want to discuss and help you navigate through is permanent establishment. And that is basically an ongoing and stable presence in a country. And it could be triggered by a fixed place of business, or it could be triggered by dependent agents operating within another country. And it can apply US company venturing outside of US, and as well as vice versa. So PE, permanent establishment standards, differ country by country. So again, referencing and going back to that tax treaty document is paramount. But a common recommendation we provide is that if a parent company creates a subsidiary in a foreign country, we recommend that the subsidiary hire its own employees there in that foreign country, and that the officers of the parent company do not habitually execute any binding agreements so that not to cross that line and create a PE. For inbound companies, so foreign company coming into US and setting up an entity in US, there could be permanent establishment considerations as well. And so we would recommend, instead of just dealing with US from a foreign point of view, we recommend setting up a US entity, usually a corporation. Sometimes, if there's a slight or minimal exposure that the foreign company might have some transactions with US, we recommend to mitigate the risk of creating that permanent establishment, we recommend filing a protective tax return, Form 1120-F. It's a fairly simple filing, but it does quote the tax treaty paragraphs and clauses. So it's important, again, to contact us to help you navigate with that. But in that case, if we file this protective return, what it does is it preserves the rights for deductions and credits to be taken in case IRS were to come in and audit your permanent establishment and tax return. It also starts the statute of limitations. So this is what we strongly recommend to a lot of our clients, and it really acts as an insurance policy against this risk. Something new that came up this year that wasn't very popular is the FinCEN beneficial ownership information reports. And this new reporting obligation, unfortunately, will impact a significant amount of small businesses under the Corporate Transparency Act. The idea of this is that it helps the IRS or the Treasury tackle the illicit activities by increasing transparency of company ownership structures. So essentially, this FinCEN, which is Financial Crimes Enforcement Network, they want to get a handle as to who owns these small businesses and LLCs, and sometimes even foreign companies that are doing business in US. Who are the owners? And the way they define it is essentially those people that exercise substantial control, and it can mean influence on a day-to-day operations. This typically could be a senior officer, it could be a board of directors. The definition is fairly vague, But basically, these entities need to file the simplified report with BOI system, file it with FinCEN, and report who are those owners. And usually it's information such as you can find on your driver's license or your passport. The timing for these are basically for any business that's been created before December 31, 2023, you have till the end of this year. For companies that are newly created in 24, you basically have 90 days since it was created. In addition, if you have any changes after filing your initial report, if you have any changes to your address information or any other, driver's license information that you would typically have, you are required to file an update within 30 days after the change. So this is a hassle that is confusing. There's a lot of exemptions too to consider. The penalties are extremely steep if you don't do that. There's even criminal penalties and years of imprisonment. So we definitely want to avoid that. But we strongly recommend reaching out to us. We actually have created a task force. We're happy to sit down with you, evaluate your capital cap table structure and basically advise as to who should be this beneficial owner to file this report. And we would be happy to screen share and help walk you through doing that to make sure you're compliant. Let's see. Next slide. Okay. So a quick update on international considerations. This is where the compliance heavy topics come in. In the past, we always talked about forms 5471, 72s, 8858s, FBARs, and what have you. Those are still there. The filings are complex. The penalties are significant. But one thing I wanted to bring up here is the change that's coming with starting in 2026. TCJA enacted GILTI, which is Global Intangible Low Taxed Income, which taxes your earnings of your subsidiaries abroad. It taxes them in US. Well, unfortunately, the tax rate is increasing from 10.5% to 13.125%, starting with 2026. And then the Foreign Derived Intangible Income, FDII, which was a benefit if you're a US company having sales to foreign jurisdictions. That is unfortunately decreasing from 37.5% to 21.875. So negative, unfavorable changes, but it's important to keep it in mind as you're planning for 2026, as you're projecting your tax liability, etc. So definitely something to keep in mind here. A quick note to payments made to foreign persons. This is something we always bring up because a lot of small businesses don't understand their obligations. So if a US company is making payments to a foreign person, such as interest, dividends, royalties, there is a withholding obligation on the US company. And that's usually filing a Form 1042 that is due annually on March 15th. And again, there is going to be a 30% default withholding tax rate in a lot of situations. However, there could be exemptions and tax treaty benefits that could be claimed on these forms. And so again, shopping and looking at tax treaties and evaluating it is becoming very important. As I mentioned, a couple of payments, interest and dividends and royalties, but I also want to bring up an important concept here that if you're paying a foreign independent contractor who performs services, the key here is to perform them in the US. So that will trigger your withholding obligation. And so if they're performing them abroad, that's fine. You're not obligated to do the withholding. The penalties are significant. You want to talk to us before you're having that transaction so that we can advise you on how to withhold, how to remit that payment to the IRS. Again, documentation is going to be key here. And if you're dealing with any foreign contractors doing work in the US for you, make sure you obtain Form W-8. Overall, this is a complex area, so definitely plan to work with us on this topic. And so at the end, I just want to quickly summarize the key takeaways. it's really important to look at your global structure as a holistic approach. It's not just tax, it's also aligning it with your tax strategies and business operational goals. Coordinating, what you have in US versus outside of the home country is also important and complex. And so we urge you to contact one of us and stay proactive to make sure that you have a smooth tax filing season. And with that, we'll launch the next polling question.
Great, thanks, Bella. Just to add in a couple of additional comments. With regard to controlled foreign corporations, the GILTI regime and the requirement to bring income back to the states, or at least report it annually, that is something that is not phasing out at the end of 2025 as part of some of the other phase outs of the TCJA 2017 legislation. So this is something that we're going to have to live with for a while. Just to underscore Bella's comment about the complexity regarding the reporting for controlled foreign corporations, when these rules came into being, the size of the tax form related to the disclosure was 6 pages. Now it's 15 to 18 pages per controlled foreign corporation. So the amount of reporting requirements that have been imposed upon taxpayers with foreign subsidiaries has just exploded over these last 7 to 8 years. And it's one of the reasons why we're seeing more people shift towards disregarded entities for their overseas operations rather than controlled foreign corporations, just as a means of simplifying the reporting. I'll also emphasize Bella's comment regarding transfer pricing. Not only should the agreements be looked at every year, but the agreement should often be, you have to adhere to them. Too many times we learn of situations where a company with multi-jurisdictional entities creates a transfer pricing study and document, dots all the I's, crosses all the T's, and then puts the document in a file cabinet. Well, perhaps that document provides for 60-day terms on payments of intercompany receivables or payables. You need to be adhering to that, so on and so forth. So it's really a substance over form argument in terms of how you operate if you are operating in a multi-jurisdictional environment. I'm going to turn things over now to Destiny Flood, who leads our outsourced accounting and financial consulting group, to talk about some other issues relating to the condition of your books so that we on the tax side can do our jobs. Destiny.
Yeah, great. Thank you, Rich. And thank you everyone for having me today. Yeah, as Rich said, my segment here today is really to serve as a supplement so the tax team and so your business can be ready for tax time and the preparation as well. So we'll go over some best practices today. All right, so Q4 is a great time to be thinking about the components that we're going to be talking about today over essentially being prepared. Is your company ready for year end? Are they ready for filing the tax returns and working with the tax team as well? As you saw today, the tax team has talked through a lot of really, really great tips, some of them really complex. And the important thing to note is that effective tax planning requires clean and timely books and records. There's a lot of preparation that goes into supplying all of these reports that Michael, Bella, and Kelly have talked about today. So what we want to do with these best practices is to avoid providing the tax team with really disorganized materials. We want to try and avoid the proverbial shoebox full of receipts, which hopefully doesn't happen in today's day and age with electronic recording. So as you all know, as business owners, there's a lot of stress and complexity that goes into running a business, and disorganized records can also result in delays, And, getting to that point around April 15th or even on the extension timing, shuffling and trying to get things ready the day before a deadline. So some best practices to avoid that. Okay, so right now is a good time where you can review your current accounting infrastructure. So we refer to a three-legged stool, essentially, of people, processes, and systems, reviewing all of that. So some things to consider within here is, does your current tax team have sufficient sophistication and capacity? A lot of times, a lot of people in the finance department wear a lot of hats. So especially around this time of year in Q4, when you're thinking about budgeting, your next year forecast, your interim tax planning, are there any projects that might make sense to move out into sometime in 2025 that can be pushed out from this Q4? Does your department have a lot of turnover or difficulty filling roles? Now is a good time to be proactive and explore some solutions that could come with that. May it be recruiting, utilizing an outsourced solution, or again, shifting roles and responsibilities within the current organization. On the timeline and close checklists, reviewing what processes and controls are in place to review that. Having a timeline put in place, especially around year end and for year end close, is extremely valuable. As we'll be talking about in just a minute, it's a great time to also look at really technical areas or areas that may take a significant amount of time and infrastructure to prioritize and put a plan in place with that. And really also a fantastic time to try and get a hold of the year-end tax request list early as well, so that, again, you can talk with your tax CPA to understand crucial and technical items. And on that note, we highly recommend in Q4 and gearing up for tax season in that kind of January timeframe as well, is to really make sure that you're comfortable and know your tax team and that you're proactively meeting with them. This time of year, our AAF tax team is reaching out to a lot of clients, especially those are also in our outsourced accounting and fractional CFO group. We meet proactively with our tax team this time of year as well. And it's a great time to essentially recap on what happened this year. Was there a significant business purchase? Was there a merger or acquisition that the transaction advisory M&A type of structure should know about? As Bella talked about, are there new foreign reporting requirements or a new subsidiary that opened? What are the tax implications of that? Again, I would say the key word of this segment is being proactive. So what we want to try and alleviate is not be talking about really significant things in March or early April when you're trying to get and actually file the tax returns. We definitely highly recommend on complex tax requests is to really just be transparent with what questions you may have. Reach out to them, maybe schedule a meeting to go over certain reports in particular. Kelly talked about with the state and local tax reporting, there's a lot of components that go into that. So she mentioned having sales by state. How do you actually report sales by state? What parameters in your ERP system do you have to pull and report on to be able to provide the SALT team with that information? As she mentioned on the invoicing side, on significant fixed asset purchases or significant vendor expenses that have occurred in the current year, on the sampling component, maybe even looking at a few invoices to check if there is certain risk within there as well. There's a lot of, the list can go on, but it's a great time of year to just really look at that and set aside time to go through pertinent questions. Lastly, we wanted to also go over some best practices in regards to what should happen for year end and that year end close checklist. Of course, It definitely varies significantly by the size of an organization, from startups to multi-million-dollar entities with large investor backs. It may look very different for a lot of different companies. So these are, of course, high-level recommendations, but I would say looking at significant accruals and reconciliations and timing cutoff, those areas usually pose the most risk, especially getting ready for corporations on having cutoff in books and records. Of course, that applies to financial statement audits as well, but we're talking about tax specifically today. Inventory is usually a very large area that is very complex. You may have to do physical inventory counts. There may be significant inventory in transit that has to be accounted for. Inventory, of course, is a very large state and local tax area risk as well. So looking at that checklist. Bella talked about transfer pricing. There's a lot of components that go into that as well. So those of you on the call that have foreign activity and foreign subsidiaries, looking through the intercompany transactions and services that are occurring amongst entities, accounting for those. Maintaining invoices and supporting documentation. So a great time to look at your systems and your filing and ERP systems for maintenance as well. And again, with this year-end close checklist and close preparation is to, again, really look at the capacity of your current accounting team. And year-end is a great time to evaluate if you may need external support, or again, on the recruiting side, just look at your infrastructure. So with that, I will hand it back over to Rich. Rich, you're muted.
Thanks, Destiny. And all of the things that we've been speaking about today really apply when it comes to due diligence. Are you taking on outside investment, Series A, Series B, or are you considering selling your company? All of these items we've spoken about are examples of how you get your business affairs lined up in anticipation of somebody coming in to take a look at your books. There was a question in the chat regarding the sale of R&D credits. The short answer is no, although there are other credits that may be sold, and we can talk to you about those separately. With regard to FinCEN, differentiating between the 30 and 90-day requirement, it's 90 days for newly formed entities in 2024, decreasing to 30 days for entities being formed in 2025. So I just wanted to clear up those misconceptions there. I wanted to thank Michael, Kelly, Bella, and Destiny for their insights today. There's a lot to consider in year-end planning over and above these issues that we've covered. AAFCPAs reminds you to consider tax planning as a year-round exercise. Issues or opportunities that you face throughout the year have tax implications. And while the business decision takes precedence, you should be aware of the tax costs going in. Some things require immediate tax planning. Some things are long-term, especially as it relates to the window I spoke about for taking on outside investment or selling your company. Thank you once again for spending your precious time with us today, learning things that we hope that you find helpful. We welcome the opportunity to help you out a tax and financial plan that takes full advantage of all the strategies that are available to you. And as always, we look forward to your feedback. Please reach out to your AAFCPA's tax partner or any of today's speakers with any additional questions.